Welcome to Breaking News to Trading Moves. We are reviewing some information you shared focused on a major earnings announcement, specifically Alphabet's. And we want to look at the potential impact on the technology and advertising markets.
Right. Our mission today is really to dissect Alphabet's recent financial report
Right?
and maybe identify some specific companies, those likely to benefit or maybe face challenges based on Alphabet's performance and, crucially, their future spending plans.
Okay, so the main event, Alphabet's Q3 2025 performance. The top line numbers look pretty solid. Record revenue I saw, $102.3 billion.
That's right, $102.3 billion, which is 16% growth year over year, pretty healthy. And net income grew even faster, up 33%.
Wow. And what drove that? Was it ads, cloud?
It was both, really. Double-digit growth in ads and in Google Cloud, both engines firing. But, for understanding the market reaction, the really critical detail, the thing everyone's watching, is capital expenditure, Capex.
Yes, the spending. That number seemed large.
It really did. They raised their Capex guidance again. The 2025 target is now set between $91 billion and $93 billion. And they were very explicit. This is focused on AI infrastructure, data centers.
91 to 93 billion. That's a huge commitment to building physical stuff. It basically guarantees a certain level of demand for whoever supplies that stuff. Right?
Exactly. It acts as a massive demand signal. When you commit to that level of infrastructure, you're essentially pulling forward orders for all the specialized equipment needed for modern AI. So, yeah, it creates a pretty immediate group of winners.
Okay, let's get into that. Segment 1, the winners. Who's directly benefiting from this $93 billion AI infrastructure spend?
Well, you start right at the heart of it. The AI chips and the gear needed to actually make those chips. Strong cloud growth plus this big AI build-out means they need more accelerators, more high-performance memory, and the fabrication tools.
So the obvious names that jump out.
Yeah, the primary beneficiaries for the accelerators themselves are, well, NVIDIA, ticker NVDA, and Advanced Micro Devices, AMD. They make the core processing units.
Right.
But it's not just the processors. You need the memory to feed them, these high-bandwidth memory chips. That points towards Micron, ticker MU. And then someone has to build the machines that make all these advanced chips.
Yeah.
That brings in companies like Applied Materials, AMAT on the semiconductor equipment side.
Okay, so it's the whole supply chain, from design to manufacturing tools. What about the physical data center itself? Beyond the racks of servers.
Good point. There's a secondary effect. This level of hyperscaler spending puts a strain on the support infrastructure. AI data centers need immense power and generate a lot of heat compared to older facilities.
I can only imagine. Cooling must be a major bottleneck.
It is. So this drives demand and often pricing power for specialized power distribution gear, advanced cooling solutions, and even just the physical space, the interconnection facility. So you look at companies specializing in that high-density power and cooling. That would be Vertiv, ticker VRT, and Eaton, ETN.
Okay, Vertiv and Eaton for power and cooling, and the space itself, the buildings.
Yeah, that benefits the data center, REITs, the real estate investment trusts. Think Equinix, ticker EQIX, and Digital Realty, ticker DLR. When the big cloud providers like Google expand, they often lease space or capacity in these specialized facilities, so demand goes up for them too.
Got it. A pretty clear picture on the hardware and infrastructure side. Let's switch gears to the other growth engine you mentioned, advertising. Google saw a double-digit ad growth. What does that signal for the rest of the ad market?
It's generally seen as a positive signal for the whole ecosystem. When the biggest player reports re-accelerating ad spend, it usually suggests that overall advertising budgets are getting stronger. Marketers feel more confident opening their wallets, and that lifts activity, auction dynamics, pricing across the board, both performance ads and brand advertising.
So if Google's doing well, others in the digital ad space likely benefit too.
Often, yes. Stronger budgets tend to flow to other major platforms and the tech that helps manage campaigns. So obviously Meta platforms, ticker Meta, could see a lift. Snap, ticker SNMP, might also benefit from that improved environment.
And what about the ad tech companies, the ones enabling programmatic advertising or connected TV?
Absolutely. A company like The Trade Desk, TTD, which is on the buy side, helping advertisers place bids. They benefit from increased activity and potentially better pricing. And platforms heavily reliant on ad revenue, like Roku, ticker ROKU, in the streaming space, also stand to gain when ad budgets are healthier.
Okay, so a broad positive read-through for digital ads. We've covered the winners quite a bit. Now, let's look at the other side. Where does Alphabet's strength potentially create pressure? Who might be facing some headwinds here?
Right, there are always counter effects. We can start within ad tech itself, specifically with the independent supply-side platforms, or SSPs. Just quickly, SSPs are the platforms publishers use to sell their ad space programmatically.
Okay, they help publishers maximize revenue. Why would Google's strength hurt them?
Well, it comes down to market share and pricing power. When a giant like Google, which has its own massive ad stack and publisher relationships, is performing really well, it can put pressure on the take rates of these smaller, independent intermediaries.
Take rates being the percentage cut the SSP gets from the ad sale.
Exactly. If Google's platform is seen as delivering strong results, publishers might shift more of their inventory or focus there. That forces the independent SSPs to potentially lower their fees or fight harder for inventory, which can squeeze their margins.
So companies like Magnite, MGNI, and Pubmatic, PUBM might feel that pressure.
Potentially, yes. They're competing in that space directly. There's also another, maybe more gradual headwind building for traditional content publishers. And this links back to that huge AI investment.
Ah, you mean how AI is changing search results pages?
Precisely. As Google rolls out more AI features directly in search, summaries, direct answers generated by AI, it can, over time, reduce the number of clicks that go out to external websites.
Because the user gets their answer right there on Google and doesn't need to click the link to, say, the New York Times article.
Exactly that. It's a slow burn, probably, but it's a structural change that could gradually eat away at the organic traffic publishers rely on from search. That could impact publishers heavily dependent on search traffic, like the New York Times, NYT, or News Corp, NWSA.
Okay, that makes sense. A potential long-term challenge there.
Right.
What about our last category of potential losers? You mentioned legacy IT and spending allocation.
Yeah, this is about vendors whose main business is tied to traditional on-premise IT infrastructure. Think companies providing storage, backup solutions, maybe networking gear, primarily for companies' own data centers, not the giant cloud ones.
But why does Alphabet spending billions on its data centers hurt them? It seems like a different market.
It's about the overall pool of corporate IT spending. Enterprises have choices when they need to modernize. Do they refresh their existing on-premise gear, buying from these legacy vendors? Or do they shift more workloads and budget towards the cloud, towards AI services offered by Google Cloud, AWS, Azure?
Ah, so the massive investment and innovation happening in the cloud, driven by this AI spending, makes the cloud option more attractive.
That's the dynamic. That huge hyperscaler Capex almost acts like a magnet, pulling enterprise IT budgets towards cloud and AI initiatives. It tends to crowd out, you could say, some of the spending that might have gone to refreshing traditional on-premise systems.
So the enterprise decides to spend with Google Cloud instead of buying new servers or storage arrays locally.
In many cases, yes, or at least it shifts the balance of spending. This puts pressure on vendors who don't have strong offerings tied into that modern cloud and AI data center buildout. So companies like Commvault, CVLT, focused on data protection, which often have a legacy component, or NetApp, NTP, known for enterprise storage systems, might see budget priorities shift away from their core markets.
Okay, I think I see the overall picture now. To recap for you listening, Alphabet's strong growth, particularly that enormous $93 billion AI Capex commitment, seems to be creating clear beneficiaries. We're talking semiconductor companies like NVDA, AMD, MU, AMAT, infrastructure players like VRT, ETN, EQIX, DLR, and a boost for the broader digital ad market, helping Meta, Snap, TTD, RKU.
But on the flip side, that same strength in spending focus creates challenges for independent ad tech SSPs like MGNI and PBM, potentially for content publishers like NYT and NWSA due to AI and search, and for legacy IT vendors like CVLT and NTAP as enterprise budgets tilt toward the cloud.
It really brings us back to that Capex number, that $91 to $93 billion. It makes you wonder, how long can traditional enterprise IT spending hold out against that kind of pull towards cloud-based AI?
That's really the provocative question to ponder, isn't it? When you see spending commitments of that magnitude focused on cloud AI, what does it mean for the pace of change across the entire IT landscape? Something for you to think about.
Indeed. Before we wrap up, we have to remind you, this information is purely the opinion of the author. It is not financial advice or a recommendation to buy or sell any securities mentioned. We strongly encourage you to always conduct your own thorough research.